Great. Well, I want to go ahead and get started to honor everyone's time this morning. But as I said a few minutes ago, thank you for joining. I know that this is a very busy time in your schedules, and so we appreciate you taking time out. The City of New Orleans was introduced to Project Equity through a Fuse fellow who used to work for Project Equity, who's working in our office this year. And we've just noticed, in the news and in conversations with small business owners that, the pandemic has changed things for some business owners. They're looking for different models, ways to invest their employees. Or they might be looking to not take on the burden of ownership just on themselves, and looking to share that, or build a legacy if they're looking to move on from their business. So we're excited to offer this webinar. We think that this is kind of a first conversation that we can have about this topic, and depending on interest, we hope to continue the conversation about employee ownership. Our guest today is Miaka Cochran from Project Equity. It's a nonprofit. It's based in California, but they do work all across the country. I'll, I guess, kick it off over to you, Miaka, to get started.
Thank you so much, Courtney, and a big thanks to the City of New Orleans for hosting this webinar. Very excited to speak with you all today about employee ownership. We're going to cover what it is, what transitions are, how they work, what the benefits are, and what you need to make it work, including readiness factors. And so the idea is to get really a broad overview with some basic nuts and bolts of how these things work, so that you can walk away with a good understanding of employee ownership 101, as well as what it would take to make it work if you want to consider this for your business, or you're working with a business that you think this could be a good fit for. So without further ado, I will jump into it. So a bit about Project Equity. We were founded in 2014, and our goal is to help business owners secure their company's legacies by transitioning to employee ownership. There's benefits for the company, the employees, the community, and for owners looking for options. This is very impactful, especially to low to moderate income workforces, and sustains high quality jobs and keeps businesses rooted in the community. So we really see this as a win on a lot of fronts. And we started doing research to figure out, hey, where do we fit in? You know, employee ownership is under an underutilized option in the country, and what needs the most help? And what we landed on through research is that there's not a lot of support and resources for business transitions to employee ownership. So there's a lot of amazing companies out there and organizations that help found cooperatives and other employee-owned business models, but there's not as much for transitioning businesses. And so that's where we fit in. That's the core of our work. And about 50% of what we do is education. We just want to get the word out, spread awareness, make sure that people know and understand these business models so that they can utilize them if it fits for them, or go further if they need to. And then 50% of what we do is fully transactional in terms of actually helping businesses take the journey. Myself, that's me, Miyaka Cochran, when I had a nice haircut and was freshly shaved before the
Oh,
pandemic.
Miyaka, I think you need to share your screen. I don't
Oh,
see it yet.
whoops.
Yep,
Okay, thank you.
no problem.
Uh, all right, there we go. Can you see it now?
Yep, working for me.
Excellent. Here we go. All right, so that's us, Project Equity. That's a bit of our team from last year. We are headquartered in the San Francisco Bay Area, but we are a remote company, and so we have people from here to Miami and everywhere in between. Now, myself, I came to this work. I was in the tech world for about 8 years prior to this, and was in the center of a number of business acquisitions that I saw go terribly wrong. Great for the company acquiring it, for the big company acquiring the companies, but for the small independent businesses that they acquired, it really turned out sour for them. And that really sparked a passion for me to figure out, hey, how can we actually provide exit options for these businesses that are good for owners, good for the employees and the businesses moving forward. And that's why I found employee ownership through Project Equity. So very excited to kind of take my skill set from working with companies through acquisitions in that world to businesses that I care a lot more about and I'm much more passionate about. So why the need for employee ownership? One of the core things that I think that pandemic has especially highlighted is that working people are just not economically secure. You know, with nearly half of US families not being able to manage even a $400 emergency expense. And then if you look at 6 of the 10 fastest growing occupations, they pay them less than $27,000 a year. And there's high unemployment rate due to COVID-19, et cetera, et cetera. And in addition, when you're looking at this from an owner side, selling a business isn't easy. When you look at national data with business brokers, for example, and the U.S. Small Business Administration, only about 20% of businesses that are for sale ever find a buyer. And there's a huge decrease in transition within families, where historically that was a classic way to keep businesses going, is passing it on to the next generation through children, nieces, nephews, etc. That's happening a lot less now, and what this results in is about 1 in 5 businesses are at risk of closing now, and this is pre-pandemic, and so that obviously is now also increasing a lot. But the unique benefits of employee buyouts for business owners, specifically, is that the owner can achieve a fair sales price. That's one of the biggest myths of employee ownership, is that, oh, to sell to my employees, I'm just going to have to, you know, take a huge cut on what I can get out of this. And that's not true in most cases. And owners can also retain influence and pacing on the exit timeline, so that they can, be in the driver's seat in terms of when they're exiting, if they want to kind of phase out, if they want to shift roles to be able to have a little bit more, work-life balance and share the burden of ownership. A lot of owners see a value in that, getting back to maybe the piece of the job that they love the most, and they don't have to wear a million hats, such as just doing straight sales or client maintenance, for example. And it's a really great way to preserve the company legacy, culture, and people, because you are not bringing in a new influence in the form of a new owner. You are empowering the employees there to become owners and step up into ownership to be able to build upon and preserve the legacy that has been established. But in addition to those benefits, it also can be really impactful to the community. So when you're looking at employee-owned business models compared to their peers, profit margins tend to be higher. Why is that? It's because a lot of employee-owned business models can have access to tax benefits that other business models do not. And so in addition to just the benefits to the employees and the owner trying to exit or sell their business, it's actually very impactful just from a financial strategy standpoint. And you also see that there's sales and employment growth grows faster against non-employee owned peers as well. Um, a lot of this is great because you can also see that it results in fewer layoffs with employee ownership. So when you're looking at the data here, it outperforms, in most cases, at least 3 to 1 in terms of, having fewer layoffs. Better wages. So this is something that's interesting, and this is actually when you kind of pull in the whole compensation package for employee owners, that employee owners get better wages over time. And part of that is the growth of the company. So the companies can have a good chance to become more profitable, and that in turn can benefit the employees. And that's all that money is going back into the community as well because ownership is remaining local rather than having an out of state or out of country owner. In addition to that, when we're looking at the pandemic, um, you know, in terms of retaining jobs in the pandemic, it outperformed 4 to 1 rate against non-employee owned peers. So there was just higher job retention among employee owned companies and non-employee owned companies during the pandemic. I want to give a couple examples because all this data is great, but what does it matter when you don't actually see a real business? So here's one example in our local Bay Area. So this is actually in San Jose, Santa Clara, and Sunnyvale. So for those familiar with sort of Bay Area geography, that's what we call Silicon Valley, or it's where Google is and Facebook and all these tech companies, and it's extremely expensive to live there. Um, and it's been really challenging for service industry workers and frontline workers in the area because they're having to work, minimum wage jobs or low paying jobs in areas that there's not housing that they can afford on those wages. Slice of New York Pizza um, was a very successful pizzeria. They turned to employee ownership and they were able to, within the first 2 years after becoming employee owned, distributed more than $500,000 of profits to its employees. So really powerful example. You're seeing people working in pizzerias and bakeries in the Bay Area actually after years of being employee owned, being able to afford down payments on houses and things like that. So it can be very life changing to employees. Um, in addition to this, it doesn't only work for specific industries like the food industry. When we think of cooperatives, when we think of employee-owned businesses, a lot of the association is, oh yeah, a grocery store, a pizzeria, a bakery. And yes, it definitely works great for those types of business models, but it's not only for those. It can work across a huge number of industries. And so here's a solar electric company um, in the Sierra Nevada foothills of California, and they transitioned to employee ownership, and it's really been transformative for them with employees really developing this ownership mentality and taking it very seriously to the point where during the pandemic, when they actually had to stop operations for a period of time, um, you know, and not able to show up at work sites and work on the projects, they actually, in that time where they couldn't work, the employee owners came up with a new business idea to produce. And so they ended up actually at the end of the year hitting their revenue goals um, even with months of missing revenue, because when they couldn't work on the projects they were working on, they were brainstorming and thinking of new ways to do the business. And this happened collectively among the employee owners, which is great because you don't have just one person stressing out and trying to figure it out. You have a lot of people coming together and figuring out new strategies to push business forward. Now, let's cover some employee ownership business models. So when we talk about employee ownership, we talk what we mean is broad-based employee ownership. So technically, if management owns the company, that's a form of employee ownership. But what we mean is broad-based, meaning that all employees or most employees should have the option and access to ownership. And that comes through three primary models. Um, the one for larger companies is called an ESOP, and that is Employee Stock Ownership Plan. So the profits of the company are actually distributed um, into a retirement plan, and the company is actually held in a trust. A worker-owned cooperative is wholly owned by the employee owners who share in profits, and there's a board of directors that is elected by and can be served on by the employees themselves. And then an employee-owned trust, which is a highly customizable model. It's a trust model similar to an ESOP, but allows for profit sharing and a lot of other things that can be incorporated as well. So ESOPs, we recommend these for about 40 plus employees, generally roughly around 5 million plus revenue, and profitability needs to be there as well because they're much more expensive to set up, and then there's ongoing administration fees. The reason for this is because there's immense tax relief for the company. The profits, because they're going into this retirement plan, are generally going to be tax free. So there's also tax benefits for the owner as well. But when you're looking at that, you have to weigh that against the ongoing administrative cost. There's a lot more oversight on ESOPs because of their tax status, and their qualified retirement plans are actually even governed like 401ks by ERISA. And so basically, it's used to transfer all of the company's shares to a trust that's ministered on the employee's behalf. So you have a trustee or a trust board or a trust management company that manages that piece, and then you still have management, leadership, and the employees who are benefiting from it. It's great. It's free to employees. There's ways that you can incorporate, you know, democratic governance and other things if you want to similarly, but it's not baked in. Now, worker-owned cooperatives, it's democratically governed. What that means is that you have a board of directors that's elected by the employees, and employees can serve on the board. It's less expensive to set up. There's tax benefits that you can participate in as well. There's an equity stake for employees. It's great because it's a very simple model and allows employees who meet a basic criteria, such as must have worked here for at least, say, 1 year, 3 years, some basic criteria. They will have the option to buy into the cooperative, but they're not required to. So you can have employees who are not involved in it and have employees who are involved in it and are worker owners. The nice thing about this is the the collective voice of the employees. They get a vote to vote on the board, and then the board is there to oversee and work with and collaborate with management. One of the things that's commonly misunderstood about worker-owned cooperatives is that not everyone is voting on everything. So if you need to, vote on what color coffee cup is in the break room, you don't need everyone to vote. There still should be management in place. You certainly can incorporate more, but it's not baked into the model. It's more that people kind of add on to this and take advantage of a worker-owned cooperative to, do other things such as participatory management, open book management, other practices. But from a very basic standpoint, operationally, the company can remain largely the same as it was before a worker-owned cooperative. Now, an employee-owned trust also can work great for small companies. We do recommend in general 10 plus employees for any of these models, but it's not a hard and fast rule. An employee ownership trust is a highly flexible model, and it's owned by a trust similar to an ESOP, and the employees are the beneficiaries functionally of that trust so that they receive profit sharing. So it's free to the employees, they don't have to pay. Day one you can get sorry, not tax, you can get profit sharing, or again you can have some sort of gate to say, like, we want employees to at least have been here for a year. And you also, usually what's baked into these is a perpetual aspect, meaning you can protect the business for the future. So you can do this with a cooperative as well, but they're generally part of the package with an EOT. If you're like, I don't want this company to ever, be sold to a mega conglomerate or, an outside buyer. I want it to continue to be an employee-owned company. You can build that in to prevent further sale. So, this was started in and really popularized in the UK. So I like to think about, that old storied, 300-year-old pub on the corner, and the owner's like, this is great. I don't want it to be sold and turned to a McDonald's. So I'm going to establish an EOT to protect the legacy of my business and ensure it's always going to be in this community and serving the employees. Now, let's get into a little bit about how transitions actually work. So we've covered the models, sort of the benefits. Let's look at what they work. So the sale of a business is done to a new entity with employee owners. So if you think about it, if you're a cooperative, if you're doing the cooperative route, a cooperative entity is established, and then that new entity actually takes out a loan to pay back over through future revenue. What that means is that the employees are not required to foot the bill or pay the bulk of it. In a cooperative model, they generally have a buy-in amount. In the trusts, it's free to them. But even with a buy-in, it should be nominal, not something that's going to break the bank or be negatively impactful for them. But it's a little bit of knowing that they have a little bit of a skin in the game. And then most transitioned businesses maintain executives and management, and employee owners are usually electing and can serve on a board of directors. Now the owner, how this works is the owners and a small group of employees agree on sale price and deal terms. So you're not going to be negotiating with the whole company as the owner. You want to kind of identify who's your core group that you want to be those founding employee owners. And those are the ones that are really going to help you on this journey with designing and building this out. And then they will represent the buying side for you. So when you get down to negotiations, they'll be the ones that you come to agreements on. Now, a transitioned employee-owned business, again, will take out a loan, and then the loan is paid off over time through future revenue. This allows for a high level of flexibility in the deal because the employees are not taking it, and the owner themselves, in most cases, will also participate in the financing. I'll talk about how that works. So when we look at 100% of a loan, generally 30 to 50% is what we call owner finance or seller financed. And a bank or community development financial institution, CDFI fund, is loaning about 50 to 70%. What this means is that, let's say that as an owner, you're like, great, I'll do 30% and I want 70% from the bank. At the time of sale, you, the owner, are going to get your 70% of the sales price, and then 30% you'll get paid over in increments over time between 5 and 8 years, including interest. Because of this, we also see commonly owners utilizing that as more of a strategy, with some owners saying, hey, I don't need all this money right now, so I'm actually going to take, a bigger chunk so I can collect more interest, or even fully finance it myself and negotiate an earnout or other option to be able to work a financial strategy and get more out of the deal. And then employee owners in a cooperative model do have a nominal buy-in, can be a couple $100, can be a couple $1,000, whatever makes sense for the business and the employee base. And that can also be done as a paycheck withdrawal, so it doesn't have to come out of their bank account. It can come out in pieces over future paychecks as well. Now the advantages. Well, first of all, it's a fair sales price. So when you're looking at these, our process and a process that's done similarly by others who do this work is a debt capacity analysis. So you look at this business and say, okay, how much debt can this business afford to actually take on and pay back over a 5 to 8 year period? And what's not going to put the business at risk of closing down the line? And what you can get out of that is still going to be within a range of your average sale prices. When you look at business broker data and sort of sales across all industries, it's going to be within that range. It can deliver tax advantages. So both the owner and businesses can potentially benefit depending on which model and entity and how you sort of work that in the design and implementation of it. One of the other things is, as I mentioned before, the owner is really going to be able to control the process. So you do have a negotiating side in the form of the small group of employees that you select to be the buying side, but you're able to really have a lot of control over the sale, the timing, the process, to really support your needs, so it doesn't have to be a very cut and dry process. It supports flexible financing, which I mentioned before as well. Like if you want to work a financial strategy to try to extract more over time versus getting a payout right now, particularly in the pandemic when, the price may be affected by the downturn of the pandemic and what you can get now. There are ways that you can say, okay, I'm accepting smaller payments now with this sales price, but I'm going to get a piece of incremental growth as additive growth as the company is returning back to stability, which is happening pretty commonly now as well. And then it's great. One of the reasons we really love it is how it strengthens local economies. It's great at preserving jobs and keeping those businesses rooted in those communities, and also keeping the money in the local economy with employee owners having more equity and more money in their pockets that they're being able to help stimulate and grow within the economy as well. So let's say that you've heard all this and you're like, wow, this sounds great, but what can I do to actually prepare for this? The first thing, regardless of any succession option specifics, seek consultation. So if you're thinking like, I'd like to retire, I'd like to exit my business in a couple years, in a few years, seek consultation, either with us or where we do free consultation for employee ownership, or a succession planner, an exit planner, a financial advisor. Really try to kind of get your head around your business and sort of what you need and what's possible and what's realistic within your business and your exit plans and goals. Review profitability and financials. This is going to be key for, again, any transaction, any transition. Look at your business. How is the profitability? Are there any areas of risk, such as a big lease that's ending soon and you don't know when it's going to come? Um, and also, just is there debt on the books that would be helpful to start paying down or kind of thing, or get off the books, and so that you can have a little bit more flexibility once you're moving into a transition. Um, and then you want to identify key employees that would engage in this process if you were doing employee ownership. You don't necessarily have to talk to them immediately, but think about who's your A team? Who are the people that, maybe it's some management, maybe it's some employees who've just, leaned into the business and have been there long term. Who are the people that you want to collaborate with and work with on making this happen? And then you also need to outline your management transition needs. If you're exiting or if you're staying and you want to adjust your role, it's important to look at, like, okay, what's the capacity internally? Who can I pass off? Maybe it's a direct to one person. Maybe it's a splitting of your duties, as many owners wear many hats, and it's not always possible to just pass off to one person. So what's possible internally, and then what's possible, what's needed externally. If you need to bring in, a GM, a president, a marketing or sales person to fill the needs that isn't within the skill set currently available or trainable. So those are the key things, and they really, um, I think they really also speak true to general succession planning as well. And now readiness factors, we have, first of all, the company does need to be profitable. 3 years profitable out of the last 5 is a good kind of benchmark. Pandemic is weird. We've had a weird couple years, so that, is taken with a grain of salt sometimes. We need to dig in deeper, but if you look prior to the pandemic, the 5 years prior, or 3 of those years profitable, then likely you're in a good place. Do you have experienced employees? We generally recommend 10 plus employees for a worker-owned cooperative or EOT, and 40 plus employees for an ESOP, or any of the other models too. They work great at large scale. And then a proven track record. If the business has been in operation for 10 years, there's more of a likelihood that it's going to continue to grow and thrive within the community. So it's not cut and dry. There's a lot of nuance in this. If it doesn't meet all of these factors, that's fine. There still can be a path forward, but if your business meets all those criteria, you're going to be in a really good spot for transition. Now, finally, to kind of wrap up here, I want to talk a little bit about how our actual transition process works, which is going to be very similar to a lot of organizations and companies within the space. In New Orleans, you have Cooperation New Orleans that does similar to work with us. We've connected with them on a few things. So whether you're working with us or with them or another provider in the space, the transition process is going to be fairly similar. And here's how it works. First, there's exploration. So how we do this is through free consultation. We're a nonprofit. We receive funding. So the benefit of that is that we can provide free consultation to you. So whether you're just curious, you're like, I want to learn more, I want to get my head around this, all that stuff in the webinar was totally confusing and I'm super lost. I need to understand this on a one-to-one basis. That's what we're here for. Or if you're like, no, I want some serious feedback on whether this is going to be viable. Here's my goals. Is this going to measure up? We can help you with that from wherever you are on the spectrum. So whether you're super serious or you're just curious, we can help you and do calls and even some light financial analysis to measure viability. Then at the point where you're like, yes, this is great, I want to move forward with this, we've given you the go ahead, the thumbs up to say this looks like potentially very viable. We can offer you a feasibility study, and so that is a paid service, but it's a 3 to 4 month deep dive that covers debt capacity analysis, financial projections. We look at management transition needs as well as employee engagement with the goal of building a strong model or like a blueprint for your business as an employee-owned entity so that you, your core group of employees, and potentially the employees at large all have a concrete idea of like this is what it would look like, including a range of recommended sales prices for you to look at based on different financing scenarios. Then at that point, if you and this core group of employees and the employee base, in general says this looks good, we want to go down this route, we can offer you a transition service. And so that takes about 9 to 12 months, including design, funding, financing, development, and implementation. So we do training, we do engagement, we work on those same 3 workflows of financial, management transition, and employee engagement and training. And then at the end of that, we bring in the lawyer and the CPA and make sure all the I's are dotted and the T's are crossed, and we've closed the sale. The owner receives payment based on the financing scenario, and the employee entity is born. And then one thing that's unique about our service is that we actually will stick around with the company for up to an additional 2 years to provide continued training, guidance, support. So everything from, hey, we have a board of directors now. How does that work? And we'll sit in board meetings and ensure that the board and management have a healthy working relationship and that new employees who are becoming employee owners have some onboarding and training so that ultimately that there is a process for the company to be self-perpetuating in that. Great. Well, that is the long and short of it. I know that there probably is some questions, so we'll get to some Q&A in a minute. If you have questions, feel free to pop them into the chat, and I want to invite you to get in touch. So in addition to my email right there, you can email me. We also have a booking link if you want to book a free consultation. In addition to that, I also want to share my direct booking link because what I've done let me exit out of this. What I've done for today and tomorrow is I've actually blocked out some dedicated time. So if anybody wants to have a conversation, you can just go ahead and book a time this afternoon or tomorrow morning. And I will actually provide, let me get my link, my direct booking link, and then I'll put that back up. And I also do want to give an additional shout out. I mentioned them to Cooperation New Orleans. They are a mission-driven organization locally right in your city with a mission to develop worker-owned cooperatives and the structures to support them. So with a focus on poor and working class, Black, Indigenous, and immigrant communities. They're a fantastic organization. We've had some really great engagement with them. And so especially if you're within one of those communities and you're looking for a worker-owned cooperative, please do reach out to them, or I'd be happy to make a personal introduction as well if you want to get in contact with me or after one of our after a consultation if you'd like it. So I'm going to put my my direct booking link into the chat, and I'm going to share my screen just for a little bit longer so he can make sure to see the other contact information as well. So there is my email, um, and and then our link to book a free consultation that won't go to me necessarily, it just kind of goes round robin to who's available. So again, if you want to get some time with me this afternoon or tomorrow or sometime this week, go ahead and book in use my booking link. I look forward to speaking with you. I'd love to hear your thoughts on the presentation. And if you have any questions, let's get to it. So we can do this a few different ways. First, if you want to, drop a question into chat, be happy to answer there. Or, if you want to raise your hand or unmute yourself, be happy to take questions live as well. So thank you again, Courtney and the City of New Orleans for
Absolutely.
hosting us.
Yeah, thank you so much, Miyaka. That was a lot of great information. I'm sure folks have questions. I did also want to ask if you could share a little bit about the fund that Project Equity announced recently.
Yes, thank you, Courtney. And I was going to try to slip in a slide about that, and I did not get a chance to. So we do have an employee ownership catalyst fund, which is a very exciting fund that's utilized for two different things. So the first is it can be used to finance employee ownership transitions. So it's one of two funds that we have that we can do that. But in addition to that, it can also provide capital for either investment for growth for the business or stabilizing capital. If you're a business that's recovering from the pandemic and you need some capital just to kind of help get back to normal, it can be utilized that with a pathway to employee ownership. So you're saying like, hey, we would love employee ownership, but we're too in the weeds right now dealing with stuff. We need to stabilize. You can get the money now with a commitment to start the transition process within a couple years. And so it's a very favorable loan terms. I will include that in the follow-up email, Courtney, so that you can also share that out with the group. But it's a really exciting fund that we've just launched in partnership with some funding from San Diego and nationally, and we can use it everywhere. So if you're a company that is looking for capital investment or stabilization money, in addition to the PPP or idle loans, if you've taken advantage of those, it can be a really great vehicle to help your business if you're wanting to do employee ownership and you would love to do it now, but that's not the biggest priority.
Awesome. Yeah, I just found the link and put it in the chat for folks as well. So thank
Great.
you. Does anybody have any questions? You can either write it in the chat or unmute. Here we have one. Are there any local attorneys, business brokers, bankers that understand this process?
It's a very good question. So I will answer it in piece by piece. So the answer is generally yes. I don't work with the attorneys or banks personally. I work on the modeling and figuring out if it's viable. But we do work nationally, and we always try to pull in lawyers and local community development funds as possible. Brokers and local banks, it depends. So we're still working with traditional banks on ways that they can more support these transitions through financing because in some cases they have a maximum or a cap of how many owners they provide a loan for in a business. So we're working to kind of help influence and change that, which is why we often tap into community development funds and other financing institutions that are mission aligned and have very favorable terms on the loan. And then brokers, I'm actually working with brokers now. There's not a lot of awareness on micro level with individual brokers on employee ownership, but I gave a talk with the Business Brokerage Press earlier this year, and I'm working with brokers nationally on helping them understand these models and incorporate them into their toolkit. But the good news is if you already are working with a broker, we can work with them. That's the short answer. So this is not preclude working with a broker. If you're not already working with a broker, you don't need one to make this happen. But if you already contracted with a broker, we're happy to walk them through it, help them understand it, give them a sense for that, and that can definitely work with their process. Um, And I received another question here. Who signs personal guarantees, leases, bank loans, lines of credit when the company is employee owned? That's a really good question. So in general, personal guarantees are usually not required. That is one of our goals with this work is to try to to minimize exposure in that regard. And the way we do this is a couple ways. So one, the fact that we work with businesses that are generally well established. They've been in operation for 10 plus years in most cases. The business legacy really is a lot of leverage. And so, the business itself can be its own guarantee basically. And so that on leases, generally it's a matter of just helping to understand the landlord or other entity that is holding, providing that lease, helping them understand these models. But you see these across all industries, they all hold leases. Usually it's a matter of a couple conversations to help explain and understand this, and there are other alternatives to personal guarantees. And if anything, what the data actually shows is that these companies are more likely to stay and survive in the locations that they are. And so ultimately, as this is growing, because we're really on the rise of employee ownership right now, as this is growing, more and more see the value of that and see that as actually safer and not requiring personal guarantees in the same way.
Great, thank you. And I see this question directed to the City of New Orleans Office of Economic Development. Can we help locally in informing these parties so that they can convey transition info to their clients? I think the answer to that is yes. We're also learning about employee ownership, and this is the first step in that process. So we are appreciative of Miaka and Project Equity for helping us out. And Miaka actually told me about Cooperation New Orleans. And so I'm looking forward to getting to know that organization better. So we will certainly make an effort to do that. What other questions do you guys have?
Yeah, and while we're waiting for some other questions too, again, feel free if anybody wants to unmute. We're a great first stop, because 50% of our goal is just awareness and education on these topics. And so if you're like, I would love, even if you don't come to work with us for transition, we can help get you connected with the right people locally as well. So that's one of our missions is really help to get people connected. Because, also, with Cooperation New Orleans, like if you come to us and we work with you, we may, even if you could utilize our services, we may say you actually are going to be a better fit for Cooperation New Orleans. The benefit of being a nonprofit is that we're not here to just sell as many services as we can. We want to make sure that you get connected with the right services that's going to benefit you and your business the most.
Excellent. Any other questions?
Hi, this is Susan Sakash. I'm with Cooperation New Orleans. I'm one of the project officers with the loan fund there. And just building off of Sally's point, and thinking of one of the things we think a lot about is how do we build the ecosystem here in New Orleans to again sort of connect those dots between the financing institutions, the small business development groups that are the ones that are often sort of first points of contact for business owners, your neighborhood economic development groups, and how to just build those connections so that we can also be best able to inform and redirect based on people's questions. So really excited that this is an opportunity to kind of start to build this piece of the puzzle and to keep going. So thank you, Miaka, for presenting, and Courtney, we'd love to follow up.
That sounds great. Thank you.
Awesome. Yeah, and that is a great point is that, the best thing you can do if you're interested in these is be vocal about it, communicate to the city, communicate to SBDC, other local organizations that you'd like to see more support for this, because the resources are out there, and we do work nationally, but we also do establish local and regional partnerships to do more targeted work, and so we'd love to be able to, we can do work in New Orleans, but we'd love to do more, and one of my specialties actually is I do I do actually work with business advisors on how to understand and actually utilize these models for their clients. And so both in the form of background consulting, where I don't even ever talk to their clients, but I'm just kind of advising them on employee ownership when it comes up and when it could be applicable. So anything from brokers, succession planners, CPAs, lawyers to a lesser extent. That's more of we have people who are more on the legal side than myself. But from a financial and succession plan and succession strategy standpoint, that's a lot of my work is just helping people understand and incorporate this into their toolkit, so they can make sure that this is an option on the menu for people.
Okay, we have another question. Is there anything for employee-owned startups, or is it usually established businesses that take this route?
That's a great question. There's definitely one of the reasons we actually focus more on transitioning established businesses is that there are a lot more resources for startups. And so if you want to follow up, I'd be happy to get you connected. Again, if you're looking at the cooperative route, Cooperation New Orleans could potentially be a fit and worth looking into as well, and connecting with. But sometimes it takes the form of like a cooperative development center, which have various locations locally and regionally, and also we work with cooperative lawyers too. So if you want to just do a pure like DIY approach, you can work with a cooperative lawyer, which we can get you connected to as well. I will give the caveat though that one important part about this is not just the legal transition, but the actual design and development of these models is very important, including employee engagement and training. Because it's not a silver bullet. It's not something that you just pull the trigger on and say, okay, we're a co-op now and everything's going to work perfectly. There's best practices that are good to implement, and getting connected to other cooperatives or other employee-owned businesses in the community. It's a great community, so one of the things that we do is get people connected to like businesses, usually out of market, in case there's like a competitive, issue. But they're able to learn and knowledge share and everything like that, which is important because what you want to unlock is that ownership mentality and employee engagement as a part of this, and like avoid the pitfalls, such as everyone having to vote on everything and everything slowing down. So, not that won't necessarily work, but for most businesses, that's not going to be a right approach. There's a healthy level of collaboration and autonomy needed within decision-making trees and everything like that. So.
Great. Any other questions? Give it another minute for those. Okay, well, if there's no other questions, then we'll go ahead and end for today. And I'm sure that, hopefully this has brought up some more questions. Miyaka has offered some times today and tomorrow that through his booking link, and Cooperation New Orleans has also put their contact information in the chat. So thanks everybody for joining us today, and we will be posting a recording of this on our website. And wait, I see one more thing in the chat. Would you recommend New Orleans economic development as well as workforce development become more involved in promotion of the worker-owned model? Our office works really closely with the Office of Workforce Development, so it's definitely something that I can bring up with their department leadership and make sure that they're aware of it, and that they're read into any kind of future webinars or ventures that we have on employee ownership. So thank you for that suggestion. All right, have a great day, everyone.
Thank you all. This has been lovely. Thanks again for having us.
Bye-bye.
All right, bye-bye.